Welcome to the 10th edition of our podcast series, Talking Data, which offers timely insights into macro data and its impact on the economy and markets. I'm Kristen Radish of Arbor Research and Trading. I will be today's moderator. Our podcast features Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. We've been asking when the bond market will wake up, and today we will be discussing if we're starting to see some signs of life. Jim, we're going to get started with you. And can you talk about, our first question to you should be, are long end yields and inflation at a critical juncture?
I think that they are at a critical juncture. You know, we'll have to see where it is, but there is talk of more stimulus, and that has gotten pushed aside as we record here until after the election. And whether or not we get that stimulus or not, I think is going to drive the near-term movement in interest rates, near-term being defined as, say, the end of the year and into early 21. And so, yeah, I do think that we are at a critical juncture. Ben, how about you? What's your view on this?
Yeah, I think, I think it's a critical juncture, but in a way that is a little different probably than you view it, in that I think that we're at, kind of resistance for yields, so to speak, or for tips break evens, be it the inflation story. I think that, with like the long end 30-year tips break evens up around 185 basis points, that's been a big hurdle historically. It's gonna be tough to sustain, I think, that momentum in the face of, heavily short positioning. And also potentially in a slowing economy. There's a lot of granular alternative data on the jobs front, as well as consumer spending over the past 1 to 2 weeks in the US that have slowed. So regardless of the fiscal policy story, I think that's going to be tough to push through unless the Fed really steps up or fiscal policy gets done sooner than later, being before the election.
I'll agree with you there that if fiscal policy falls apart and we don't get it, then I do think that any movement towards high yields or higher yields will kind of dissipate at that point. But I'm operating under the assumption that we're going to get it. President Trump tweeted out today that, no deal until after the election, but they were ready to do 1.6 trillion. And they're, so we're talking about trillions of dollars of stimulus if Trump wins. If Trump doesn't win, I suspect you're going to get even more stimulus with a Biden presidency, especially if there's a blue wave and they retake the Senate as well too. So I'm looking at this idea that by hook or crook, it's coming one way or the other, this stimulus. And I do think that that could possibly push yields through the upper end of that range. And I agree with you. We're sitting right on resistance right now, although we have been setting record lows in bond market volatility. So it didn't take much for us to get back to resistance as well. And what's your thought?
Yeah, I think this gets back to kind of the second part of this part is, when could inflation, core headline, finally pierce 2% on a year-over-year basis? And this is where you and I think, disagree the most. So on my side, what I've seen is a heavy boost to core CPI, which, 60 basis points on a month-over-month basis in August. That's been fueled by an inventory issue. So same thing with the housing market, with inventories falling 40%. The biggest pushers to that kind of flexible core CPI was used car prices, 40% of it. And that's due to really, again, a lack of inventory. Same thing with appliances. So if we do get a little bit of a slowdown with a broken job market in consumer spending, I think the CPI, both on a core and headline basis, are going to retreat towards long-term averages and stay there for the foreseeable future. But I know you have a different take on that looking into 2021, right?
Yeah, I'm an inflationista. I'm trying to find a good song for the inflationista as well too. It's maybe a version of the Macarena or something. But I do think though that when you get past the shutdowns in, say, April or May of next year, so year-over-year changes in a year, I think that you're going to see higher inflation. Now, let me define higher inflation here, because when I say I'm an inflationista, I know, if you're of a certain age, you go, oh, I remember when it was double-digit inflation. No, if core PCE, the Fed's favorite measure, goes back to 2.5%, it's a 28-year high. 1993 was the last time it was above 2.5% for more than 2 consecutive months. as well too. So that's what I think I'm kind of basing my view on, is that kind of level. Now I understand that the Fed guys will say, yeah, bring it on. 2.5% would be great news for us. But be careful what you wish for, because ultimately, I go back to the fourth quarter of 18. The Fed said that the balance sheet reduction was on automatic pilot. It was going to be like watching paint dry. The market threw a fit, and within 2 weeks, the Fed completely changed its policy. If you were to get some kind of rise of inflation, and again, I'm defining it as 2.5%, I think the market throws some kind of a fit, that's higher rates, and then the Fed will wind up changing its policy. Lastly, why do I think we're going to get higher rates? I don't think it's going to come from monetary policy. I think it's going to come from fiscal policy. You've got the economy at a lower level of GDP now than a year ago, so you're producing less stuff, just to kind of make it simple. You're trying to stimulate. You've pumped trillions of dollars of stimulus into the economy already. I suspect you're going to get more. You're going to artificially stimulate demand. Less stuff, more demand, higher prices. That's how I see that the inflation will come about. Oh, it'll only be 2.5%. Be careful, because if the bond market goes to 1.25 to 1.5 yields, it might be the fit that we're looking for. Now, where am I wrong on that, Ben?
Oh, I don't. Okay, well, so I think it's going to be hard. Again, there's no evidence historically, so thus far to show that we get this big money supply, or if we get a larger degree of fiscal stimulus, that it's going to produce inflation, especially in the core front. One thing that that is interesting that maybe fits into your storyline is that the markets and investors, that is the big risk. That is what they are not pricing in. So if you look at inflation swap caps floors or many other different markets, the probabilities of us seeing 2% inflation even over the next 5 years is somewhere around 30 to 35%. And it's remained that way for the past couple of years. So I think that yes, that is the big risk, but I also think they're pricing that out for good reason, because I just don't see it happening. I think that we get the fiscal stimulus. Yes, it can lead to higher spending, and we saw that with higher savings and personal income. But I think there's still too much wood to chop, especially on the low wage side of this issue in the services industry. And that distortion is going to be with us for a while. And I think that lasts pretty well into 2021, allowing the Fed to remain, of course, dovish. And I think the yields will remain pretty constrained. The other thing too is the Fed could always unleash some opportunity, or take advantage of an opportunity to potentially extend their purchasing activity and flatten the curve, essentially. That's something that we haven't seen them necessarily do yet, but that's still in their toolkit.
Right. Last thought on this subject real quick is I'm also of the opinion, or of the assumption, that we're going to get stimulus, and if it doesn't produce inflation, we're going to get more. And if it doesn't produce inflation, we're going to get more and more and more, and we're just going to keep going. That's going to be the argument. We got a $3 trillion deficit now. If we don't get inflation, we'll go to 4. We'll go to 5. We're not going to eventually just arbitrarily say at some point, especially in a Biden victory, oh, we've done enough now, we're done. If you don't have inflation, the MMT crowd will keep saying, keep going, and we'll just keep going until we get it. And so that's why I ultimately am worried about this whole thing as far as stimulus goes.
Right, but I think it does depend too on the amount of available resources too. So as we gobble those up, it depends how much slack is remaining there. But yeah, I think the big question mark, I agree, is with Biden winning, and this kind of gets to the next question too, is how far do they push that pedal, and will that be enough to prompt an increase in inflation that is really truly unexpected by financial market participants?
Kristen, what's the next question?
So why don't you talk a little bit more about if the deficits matter, and can the Fed counteract with dovish policy? If we could get into that.
Ben, you take that one first.
Sure. Yeah, I think the deficits matter less than Jim is giving them credit to. I think that for years we've been kind of fear-mongered by politicians, especially on the Republican side. Not that I'm taking sides necessarily, but that deficits will ultimately haunt us down the road, and they'll have to be paid for. Now, that of course the MMT concept is that we have our own currency and a monopoly on that, and it doesn't matter, we can print and pay for it. I get that to a certain extent, but I also can see historically the deficits themselves have never really come to damage financial markets or cause interest rates to gyrate exceptionally. So I don't even think we're close to the levels, even though we have this, you have a great chart, Jim, that shows how obscene the federal deficits become, but I still think we're not even close to reaching the point at which it would bruise or injure the financial market.
See, I agree with you on the first half of that, is that for 40 years, since 1980, we've worried about the deficit, and we've worried that the deficit is going to crowd out the bond market, create inflation and all this other stuff. But we were worrying about the deficit in a period of 2% of GDP, 3% of GDP. At its worst during the financial crisis, it hit 10 for a moment. Back in the 1980s, it hit 8 for a moment. Today, it's 15% of GDP, double almost what it was in the 80s, 50% larger than the Great Depression, or Great Recession, excuse me. And we're talking about piling more on and piling more on. The MMT crowd, they will say that the deficit, there is a point out there in theory that the deficit will matter. And it's not that it never matters, and that their argument has been that it's much higher than people think. They're right on that. It is much higher. We've gotten to 15% right now without a serious concern about inflation. I'm just afraid that we're going to try and go to the next level and to the next level and to the next level as well too. So yes, I don't think that what we've learned is all this talk about a 3% versus 4% of GDP deficit, that didn't matter. But now that we're at 15, potentially wanting to pile on more, 15% of GDP, I think it might eventually get to that point where it does matter.
Well, the big question then, Jim, too, I'm curious what you have to say about this, and I'll give my thoughts quick, is how much will the Fed be willing to be complicit in that, and we've joked, you and I, about the potential merger or the actual already merger between the Treasury and the Federal Reserve. But the more that actually truly becomes ingrained, and the less that they're now, the more that they're going into a subjective type of framework for setting monetary policy. I mean, they have the ability, if they so choose, to keep interest rates pretty low and control them to a degree that's pretty hefty. Do you think that the Fed really wouldn't be able to help be supportive in that environment and not allow, for example, like the bond vigilante type story to really ensue, where they'd be forced to act and raise interest rates?
Well, first of all, I do think that the Fed is going to be a lot more accepting of higher deficits and potentially more stimulus. They did that by changing their policy last month. And this push that, in 1977, the Fed was given a dual mandate: high employment, low inflation. They've treated those two things equally until last month, where they basically said, now we think that the employment part of it is more important than the inflation part of it. So that's why they're going to average inflation targeting and going to let inflation run. And as I said, I think that it will only work as long as the market allows it. I've heard a great analogy for this. The Fed is a post and the market is a horse, and the market is tied to the post, so it doesn't go anywhere. That's yield curve control, or the Fed, what you've got. You spook the horse, call that inflation, it will rip the post right out of the ground and run away. And so that's where I'm afraid of, is that at some point when we get to that inflation, the Fed, even if they announce yield curve control and everything else, they can't stop the market. It's the horse that can just, tear up the post and do what it wants. Currently, it doesn't want to do anything. It's perfectly happy being tied to the post right now.
Well, that brings up
myself.
That is very good. I actually saw that in news clips this morning and chuckled, and it made sense. It was really good. So that kind of gets to our last question, Kristen, I think, about the market side of things.
Yes, so investors are already positioned or hedged for higher yields. Can you comment on how does this matter?
Yeah, I can go real quick. So this is, I think, kind of the conundrum right now, is that we're on the cusp, like Jim and I were saying, maybe disagree on what direction things are going to go from here, but with tips, break evens, yields, long end yields, looking like they could finally, really rise appreciably and maybe see some inflation this year or next year, investors have already positioned that way in a very heavy way. So if you look at commitment of traders report, long bond futures, have a negative 18% of open interest in terms of the level of short. That's the most short they've been since April 2010. If you look at swaptions and the difference in premiums, that's tilted heavily towards higher yields. JP Morgan Treasury survey, go down the list. So that's kind of a conundrum here that can yields really rise in an environment where there's such a heavy short positioning, and historically that's kind of been been difficult for them to do. So Jim, how are you feeling about that? Do you still think that maybe we had the big low here, but can we really see higher yields if everyone's kind of tilted in one direction?
Well, there's the big offset to that. I get it that in a normal environment, when you see everybody is bearish on the commitment of traders, and I would just throw in the one caveat that, yes, you're right, the long bond numbers are very, very bearish, and there are some others, but the 10-year and the 5-year are not. But it is bearish on the long bond. You've got the big offset, and that is the Federal Reserve. Right now, they've been buying a tremendous amount of bonds. They bought $18 billion worth of bonds yesterday through their quantitative easing program and permanent open market operations. So they're a giant offset. So I would agree with you that that is a concern, that you've got that much bearishness built up in the market. But let me end it on this idea. Volatility is mean reverting, and we have been in the bond market. We have been running a record low volatility, where you don't have anything close to that in the stock market. You don't have anything close to that in the Forex markets as well. And that the mean reversion in the bond market would be higher volatility. But bear in mind, the bond market is not like the stock market. Higher volatility can also come about because of lower yields, as well as it can come about because of higher yields. Ben, what's your final thought here about mean reversion and volatility? That even if I'm wrong, we could still get vol. It could just come with lower yields. But if the idea is that we're just going to keep marking, hey, today's another day that we're at 66 basis points for the next 4 more months, right, I think that's the least likely outcome. What say you?
Yeah, I think the Fed has obviously a ton of control right now, and they've been allowed to have that control on the bond market and compressing volatility. But I think you see inklings that investors are not necessarily as happy with that kind of scenario any longer. So if you look at the MOVE index at implied volatilities out the curve from 2 to 30 years, the 3-month versus the 1 month has gotten a tremendous gap, almost to an extreme of sorts. And historically, that has been followed very habitually by a rise in volatility. So I would not be shocked at these dastardly low levels, that if we don't get this fiscal policy environment, like you said, we can get high vol with a move to lower yields. We don't necessarily have to break to brand new low yields, but to see a move to lower yields, vol will indeed be higher. I would, again, a couple months ago, I'd say, hell no, not going to bet on that. But I think going into year end, I would not be shocked to see the MOVE index stair step, moderately higher as we push along, and that the markets become less comfortable with the Fed having so much control on the long end of the curve.
Yeah, Kirsten, let's wrap this up.
Yes, Jim, I'll let you just give your final thoughts for the day here.
That I think our conversation, to take away from it here, is that this is the push-pull in the bond market right now. It's not clear where we're going from here. We've got a lot of cross currents that we've never had to deal with before, such as the Federal Reserve's involvement coming back from the COVID crisis as well too. And what I've been most surprised by is the extraordinarily low levels of volatility in the bond market. I don't think they last much longer. Something's going to have to give one way or the other here.
Ben?
Yeah, I think it's going to come down to fiscal policy uncertainty. I think that a delay, pushed past the election will be enough to cause enough struggle, especially if you do get this rolling over in the job market and in consumer spending that we're starting to see in search activity. And I think that does, coming at it from a completely different angle, but I would agree that I think Treasury vol will rise, and Treasuries have been really an out of favor investment or asset class. Other places, investment grade credit, even high yield, MBS have been preferred. And I think that if we do get a real risk off, we could finally see some movement in Treasuries, which will likely boost that vol.
Well, thank you both for sharing your thoughts and your views today. We really appreciate it. And thank you for our audience for joining us today. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm that produces innovative research across a broad range of global fixed income, equity, currency, and commodity markets. Bianco Research and Arbor Data Science are our two most prominent research offerings. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com.